The richest families on the planet operate under a financial philosophy that directly contradicts everything taught in business schools, personal finance courses, and investment seminars. While millions chase diversified portfolios and compound interest formulas, these families build empires through principles so counterintuitive they seem reckless to conventional investors. The gap between common wisdom and extraordinary wealth isn't about access to better opportunities. It's about operating from a fundamentally different understanding of how money actually multiplies across generations. Walk into any financial advisory office and you'll hear the same sermon. Diversify your investments. Buy index funds. Dollar cost average. Stay the course through market volatility. Retire at 65 with a nest egg that generates passive income. This advice sounds reasonable because it's designed for reasonable outcomes. It's the financial equivalent of playing not to lose, rather than playing to win. The strategies that protect you from catastrophic loss are the same strategies that guarantee you'll never achieve transformational wealth. And here's what nobody mentions in those advisory meetings. The people giving this advice wouldn't be sitting in that office if their own strategies had made them wealthy. Jewish financial wisdom operates from an entirely different premise. It doesn't ask how to protect what you have. It asks how to create exponential value where others see only linear growth. This isn't about religion or ethnicity. It's about a collection of principles refined over centuries of operating in hostile economic environments, where traditional paths to wealth were systematically blocked. When you can't rely on institutional support or generational land ownership, you develop different muscles. You learn to see opportunity in chaos. You build networks that transcend geography. You focus on assets that can't be seized or destroyed. The resulting approach to money looks alien to conventional investors because it prioritizes different outcomes entirely. Consider how most people think about business investment. They analyze profit margins, market size, competitive landscape, projected returns. They build spreadsheets modeling best-case and worst-case scenarios. They diversify across multiple ventures to minimize risk. This approach makes perfect sense if your goal is steady, predictable growth. But it guarantees you'll never dominate a market or create category-defining value. Traditional diversification is risk management theater. It feels safe while ensuring mediocre returns. Jewish investment philosophy inverts this completely. It concentrates resources into singular opportunities where asymmetric returns are possible. It accepts higher probability of failure in exchange for exponentially higher upside when success hits. This isn't gambling. It's calculated concentration based on deep understanding of value creation dynamics that most investors never study. The difference becomes obvious when you examine how capital gets deployed. Conventional wisdom says invest in established markets with proven demand. Find your niche. Compete on execution. Scale gradually. Build sustainable competitive advantages through incremental improvement. This creates comfortable businesses that generate decent returns. It never creates industries or reshapes markets. Jewish entrepreneurial tradition does the opposite. It looks for broken systems, inefficient markets, and unsolved problems that everyone else considers too complex or risky. It enters spaces where conventional analysis says the odds are terrible because that's exactly where transformational opportunities hide. When everyone else is calculating why something won't work, a different mindset is asking what would need to be true for it to succeed spectacularly. Take real estate as the clearest example. Standard investment advice treats property as a stable, appreciating asset class. Buy in good locations. Hold long-term. Collect rental income. Benefit from leverage and tax advantages. Diversify across multiple properties to spread risk. This builds wealth slowly and predictably. It's the financial equivalent of a savings account with slightly better returns. Now look at how generational wealth actually gets built through real estate. It's never through buying multiple average properties. It's through identifying single transformational opportunities. A neighborhood everyone considers dead that's actually on the verge of renaissance. A property type the market undervalues because it doesn't fit standard categories. A development play where you're creating value rather than buying existing value. The key insight is this. Buying 10 properties that might appreciate 10% gives you modest, diversified returns. Buying one property that appreciates 300% because you saw something others missed creates generational wealth. The concentrated bet that conventional wisdom calls reckless is actually the only path to extraordinary outcomes. This principle extends to every domain. While typical investors spread money across 20 stocks, wealth builders put serious capital behind 3 companies they deeply understand. While standard advice says maintain 6 months of emergency savings, generational wealth families keep minimal cash and maximum deployment in productive assets. While conventional thinking optimizes for safety and steady growth, the opposite approach optimizes for asymmetric upside and accepts the volatility that comes with it. The psychological shift required is enormous. You have to become comfortable with being wrong frequently in exchange for being spectacularly right occasionally. You have to override every instinct towards safety and predictability that traditional financial education instills. Where are you watching this from right now? Leave your city in the comments because understanding these principles matters everywhere, but implementing them looks different depending on your local market dynamics and opportunities. The education system makes this shift nearly impossible for most people. From childhood forward, we're taught that the correct answer is the safe answer. Take the guaranteed B over the risky A. Choose the stable career over the uncertain venture. Save rather than invest. Diversify rather than concentrate. Every institutional incentive points toward risk avoidance and gradual accumulation. This produces employees and middle managers, not wealth creators. The entire framework is designed to create productive workers for existing systems, not people who build new systems. Jewish educational tradition does something radically different. It teaches argumentation, debate, and challenging established interpretations. It rewards questioning authority rather than accepting it. It builds comfort with uncertainty and multiple competing perspectives. These aren't religious practices. They're cognitive training that produces fundamentally different decision-making patterns around risk, opportunity, and resource deployment. Look at how most people evaluate opportunities. They list pros and cons. They weight factors. They seek consensus and validation from others. They move forward only when the safe path is clear. This feels responsible and mature. It's actually a recipe for perpetual mediocrity. Extraordinary opportunities never have clear, safe paths. They require conviction when data is incomplete. They demand action when conventional analysis urges caution. They need concentrated resources when wisdom says diversify. The ability to act decisively with incomplete information while others are still analyzing is what separates wealth creators from wealth preservers. Traditional financial education actively undermines this ability by teaching that every decision should be fully analyzed, validated, and de-risked before implementation. The network dynamics are equally crucial and equally misunderstood. Conventional networking is transactional. Exchange business cards, connect on LinkedIn, maintain professional relationships that might generate referrals or opportunities. Build a diverse network across industries and geographies. This creates weak ties that occasionally produce modest value. Generational wealth is built through completely different network structures. Dense, interconnected clusters where everyone knows everyone and information flows instantly. Networks built on deep trust rather than professional courtesy. Relationships that span decades and generations rather than lasting until the next job change. The value isn't in network size, it's in network density and alignment. 10 deeply connected families who genuinely look out for each other create more opportunity than 1,000 LinkedIn connections. The concentrated network mirrors the concentrated investment strategy. Quality and depth over breadth and diversification. Time horizon completely inverts too. Standard financial planning works in quarters, years, and decades. Save for retirement. Build wealth over your working life. Leave something for your kids. This treats wealth as individual achievement bound by a single lifespan. Jewish wealth philosophy thinks in centuries. It asks what decisions today position descendants 3 generations forward. It builds institutions, not just bank accounts. It creates family systems for transferring not just money but the wisdom to steward it properly. It invests in education, networks, and capabilities that compound across multiple lifetimes. When your planning horizon extends beyond your own life, entirely different strategies become rational. You'll make investments that won't pay off for 50 years. You'll prioritize relationship building over immediate returns. You'll focus on reputation and institutional strength rather than quarterly profits. The longer time horizon unlocks strategies unavailable to those thinking in conventional retirement planning cycles. The relationship with failure fundamentally differs too. Traditional investment advice treats failure as something to avoid through proper planning and diversification. The goal is steady accumulation with minimal drawdowns. This sounds prudent, but it's actually the most dangerous approach possible. It creates fragility disguised as safety. When you've never experienced significant loss, you haven't built resilience for when it inevitably arrives, and it always arrives. Markets crash, industries disrupt, black swans appear. The investor who's carefully avoided all failure through diversification and conservative strategies is psychologically and operationally unprepared for catastrophic events. Generational wealth families do the opposite. They expect failure regularly. They build systems that survive and learn from it. They know that concentrated bets mean concentrated failures, and they structure everything to ensure failures are educational rather than terminal. The ability to fail hard, learn fast, and deploy lessons immediately is what enables the asymmetric bets that create extraordinary returns. You can't learn this from books. You learn it by taking meaningful risks and sometimes losing significantly. Watch successful entrepreneurs from any background and you'll see this pattern. Multiple failures before the breakthrough success. Concentrated bets that didn't work before the one that exploded. Willingness to risk everything on ventures that conventional wisdom said would fail. The difference isn't luck or timing. It's a fundamentally different relationship with risk, failure, and resource concentration. Traditional financial advice would have stopped every successful entrepreneur before they achieved anything significant. Diversify. Hedge your bets. Don't put all your eggs in one basket. Keep your day job. This advice protects you from catastrophic loss while guaranteeing you'll never achieve catastrophic success. The asymmetry works both ways. Here's what actually matters when building serious wealth. Deep understanding of specific domains rather than surface knowledge of many areas. Concentrated deployment into high-conviction opportunities rather than diversified spreading across many mediocre ones. Long time horizons that enable strategies unavailable to quarterly thinkers. Dense networks built on genuine relationships rather than transactional connections. Comfort with failure as part of the learning process rather than something to avoid. Willingness to act on incomplete information when conviction is high. These principles sound risky because they are risky. They're also the only reliable path to extraordinary outcomes. The choice isn't between risky and safe. It's between risky with asymmetric upside versus safe with guaranteed mediocrity. The market reinforces conventional thinking at every turn because conventional thinking creates predictable, exploitable behavior. When everyone diversifies into index funds, someone profits from managing those funds. When everyone follows the same safe strategies, the opportunities for asymmetric returns concentrate among those willing to deviate. The entire financial services industry is built on selling safety and diversification because that's what creates recurring revenue streams. Actually, transformational wealth strategies can't be packaged into products and sold at scale. They require judgment, conviction, and willingness to stand alone that can't be commodified. This is why truly wealthy families don't follow the same advice they often fund through financial institutions serving mass markets. Everything you've been taught about building wealth slowly and safely isn't wrong exactly. It's optimized for a completely different outcome than you think you're pursuing. It creates comfortable middle-class stability, not generational wealth. It protects you from losses while ensuring you'll never achieve transformational gains. And it does this while making you feel smart and responsible for following expert advice. The real question is whether you want the outcomes that conventional strategies reliably produce, or whether you're willing to adopt fundamentally different approaches that enable fundamentally different results. Most people say they want extraordinary wealth while following advice designed to produce ordinary outcomes. The cognitive dissonance never resolves because the underlying assumptions never get questioned. Those who truly understand that conventional wisdom is designed to produce conventional results. Drop this in the comments. I choose asymmetric upside. Let me see who's actually processing this at a deeper level versus who's just nodding along. This kind of perspective that directly challenges what every financial institution teaches is exactly what this channel keeps delivering. You just absorbed a framework that most investors will spend entire careers never understanding. Subscribe to the channel because this is just the foundation level of how elite wealth actually operates. And consistently smash that like button so this reaches people still trapped in conventional thinking that keeps them perpetually comfortable, but never wealthy. What I'm breaking down in the next video makes this look like elementary school compared to the graduate level mechanisms that actually move billions between generations, while everyone else is still calculating compound interest on their retirement accounts.